Now let's talk about general reasons why this is a good time to take a check. One of those is taxes. And it really doesn't matter when you filed your taxes, there's some potential opportunity here. Let's say that you're the type of person who files on time every April 15th. You're a W-2 employee. Well, now is the perfect time if you don't have a relationship with a tax preparer or need a new one to reach out. Because I can tell you that most proactive tax planners that I work with, they are already closing up shop for new clients by the end of December or early January. And I can't tell you how many people, clients will reach out to me, friends reaching out to me saying, hey, do you have a person that I can talk to about my taxes? And they're asking me in February or March. And everybody to whom I refer them tells them, hey, we're not taking on any new filing clients for this tax season. So now is the time to reach out and establish a relationship if you don't have one. If you already do have one, now is the time to have a pre-meeting where you can have some strategy and have a few months to enact that strategy. So for example, when you have that relationship, you want to tell them, hey, by this point in the year, there's a few months left, but here's what I've earned in W-2 income. Here's what I've received in bonuses. Here's what I've received in equity compensation. Here are the capital gains that I've had from selling investments or selling investments at a loss. And giving that tax preparer the opportunity to kind of project a vision of what your tax return could look like could be the difference between you being surprised at what you owe or having the ability to save up over the course of the next 5 or 6 months to make sure that there's money there to pay. Because I can tell you, in my experience of reviewing client tax returns, one of the most consistent sources of extra surprise tax bills is an under withholding of things like bonus income or equity compensation or a lack of knowledge for how investment activities and things like that will impact your tax return. And even if it's discussing things like charitable contributions or healthcare expenses, having that conversation now gives your tax preparer the ability to make changes, to give you recommendations to stem the tide in a way that they simply can't when you talk to them after the calendar year has finished. Because another consistent thing that we see is we have people who are frustrated with their tax preparer because they got a bill. And when you ask them, when did you meet with them? It's not until the year is over. How can you expect them to help you limit your taxes if you're not talking to them until after the time when limiting your taxes was possible? So if you file on time, now's the time to have the pre-meeting with enough of a buffer to make changes for your upcoming April 2026 tax deadline. If you're the type of individual who files late, then October 15th is the deadline. Many businesses file on October 15th, and this is the time for the end of tax year meeting where you have those kind of last emergency steps that can be taken. For business owners, a big one is taking advantage of things like the QBI deduction. And the QBI deduction is a huge deduction from which a business owner can benefit, where they can deduct up to 20% of the net profits from their business from their individual tax return. However, there's a lot of strategy that goes into this, especially for high income earners, and especially if you're in a specialized service business, like someone who works in healthcare or a consultant or an attorney or a financial advisor. Because once you reach certain income levels, there's a threshold where you can't just necessarily take the 20% of net business income. You, in some cases, will be limited to the lesser of 20% of your net business income or 50% of the W-2 wages that you paid as an employer. So for example, let's say that we have a really high income earning consultant who operates as a single member LLC. Well, in this case, there's no employees to which they've paid W-2 income. And if they're in that threshold where they have to take the lesser of 20% of net profits or 50% of W-2 wages, and they didn't pay themselves a salary for the year, they have eliminated their ability to take advantage of one of the biggest tax deductions available, all because of poor planning. This is why you often see people who are in those high income levels and business owners themselves pursue things like an S Corp, where they can have a salary for themselves, but avoid payroll taxes on the profits of that company. But all of those things are things that have to be planned for ahead of time. And if you're at the end of that tax deadline and you need to show on paper a salary, for example, that's when you can meet with your CPA to say, hey, would it be helpful to give myself a $25,000 salary or a $50,000 salary or a $200,000 salary on paper so that I can take advantage of this deduction and strategize in the right way? For many reasons, whether you're filing in April or October, September and early October are great times to review with your CPA.